his only solution is, history says, they're going to print money. They're going to print money, because what does print money do other than what I've already said? It makes the value of the debt today less in the future, because money becomes less, has less purchasing power. So they just keep printing more money, hoping it's going to stimulate the economy without going into major hyperinflation. And that's what he thinks the government's only choice is going to be, given where we are today, our debt levels, our growth levels, et cetera. So it's a dire warning, but I think it's a warning that we should listen to.
Alrighty, folks, I want to talk about what might be the worst case scenario for the U.S. economy. What am I referencing? I'm actually referencing some comments made by Ray Dalio right after the Moody's downgrade. If you don't remember this, Moody's, I think it was 2 weeks ago, was the third and final credit rating agency to downgrade the U.S. debt from AAA to AA plus or whatever it is. But Ray Dalio came out that afternoon, or quite possibly the next morning, saying Moody's missed it. Moody's missed it. The real risk is that the U.S. economy is barreling towards an uncertain future where the Fed, the Treasury, the government may be only left with one answer. And that answer is to print, baby, print. I want to talk with someone who's referenced Ray Dalio many times over the last 5 years, kind of summarize what she thinks Ray means, and then quite possibly, if this worst case scenario is going to happen, what should you and I do? Anna, there is a lot there. I think Ray Dalio has been out a lot the last week or so. He has been rather negative for quite a while, but he is certainly on top of this today, saying, guys, you're not seeing it. The Fed is going to be left with one option, and that is to print. What do you think?
Yeah, I'll start with saying this. A lot of how I'm framing, how I'm looking at things now versus maybe 3 or 4 years ago has really been informed a lot by Ray Dalio and others as well. And when I first read his materials, I will tell you that, like you just said, I thought, well, this is kind of dire, seemed a little more doomy. But then I realized, no, there's a lot that he has to say that's really based on reality that we just haven't been hearing, paying attention to, or listening to. And the first, I think, book that I read of his was Principles of a Changing World Order, where he talked about the rise and fall of countries and how it kind of happens historically, and then Principles of Big Debt Cycles. And his overall thesis is essentially that what he did is he took about 100 of his employees and researchers over a 10-year period, because his investing mindset, he was a big leader of a very large, one of the largest, wealthiest hedge funds in the entire world for years, was it's not the things that I understand that get us. It's the things that we don't understand. It's the things that don't happen very often. But he learned to realize that most things repeat, or, in these cycles that repeat, there's similar themes. And so what he did is he put a bunch of his employees dedicated to just researching the rise and fall of monetary orders of countries and the big kind of things that make huge shifts in the financial trajectory of a nation, whether it's temporary things like the Great Recession or the Great Depression, or whether it's something more lasting, like we see the rise and fall of major superpowers in the past, the UK, the Dutch, the Germans, etc. Greece, was strong and fell. And so you had Japan that rose and fell to some extent financially. And so with all that said, his views are very well informed with a lot of data and research behind it. And I have found him to actually be fairly hopeful in the past couple of years, even though he had these big concerns. And so his books are really about saying to countries, and the US in particular, but China as well, as he's been an international advisor, that the key points of economic growth and sustainable economic good for the vast majority of your people is, one, having production, things that are going to stimulate economies and keep people working. Number two, keeping your expenses low and making sure you're not spending as a country more than you bring in tax revenue. And then if you get into too much debt, you need to start being very, very careful, because eventually money basically has buyers and sellers. There's demand for debt, there's supply of debt, i.e. how much money is in circulation. And that impacts interest rates, right? So bondholders want to be paid a good interest rate to hold an IOU, which is basically what currency is. But debt holders want the lowest rate they possibly can. And so somewhere between there, sovereign debt matters, and how much you have printed impacts the demand, the purchasing power of that dollar, the demand of people to purchase those dollars and hold them for savings versus the interest rates at which they can productively take on debt and still make a profit. And so all of these things have a lot of control at the central bank level and at the fiscal policies and monetary policies of government. So that's the high level thesis. So what, where are we, right? The United States debt has gotten so large because of decades and decades under both administration of spending more than we take in. And we also have had a lot of inflation. A lot of that came from the money printing. So when he's talking about money printing, what does money printing do? It makes the number of dollars in circulation more, and it then devalues the value of the $1 you hold, because now instead of 1 out of $100, you've got 1 out of $1,000 or 1 out of $1 million. And so your purchasing power and the value of the dollar you hold as government prints money actually goes down. That creates inflation, and we have seen that. So the risks that Dalio has been warning about for about 3 or 4 years, if not longer, before I started really listening to him, was that when governments get to a point where their debt payments, the interest that they pay on that debt, is a large percentage of the expenses of that nation, it becomes very dangerous that they and very important that they make some changes. And what those changes, Dalio argues, have to be are: one, cut expenses, austerity. It's when governments, and they often do this during war, we're going to cut out all these other social programs, we're going to focus on this thing. And that cutback is basically for the purpose of reducing their spending versus what they're taking in. The second thing is, if that's not enough, they've got to raise their tax base. So they've got to charge higher taxes from the public to cover the increase in expenditures. At some point, nations run out of the ability to tax their people enough to cover their expenses when they spend too much money. And then people pull back, and you tend to kind of go into a depression. They have less money left in their pocket after paying taxes. They're less productive. If those two things don't work, Michael, history says what nations do is they devalue their currency. So they put more out in the population to try to stimulate the economy, make people feel like they have more money. And if it doesn't result in a lot of inflation or hyperinflation, what it will result in is a devalued purchasing power, even if they're not seeing or perceiving prices going up. And so Ray has said, US, you've got to get your spending under control, and you got to charge people more taxes. So he's been saying that for quite a few years. He's been an advisor to many governments and an advisor to Scott Bessent, who is our Treasury Secretary. And Trump's financial plan is in large part similar to what Dalio is recommending. So DOGE, the point of DOGE is to cut expenses. It's austerity. Some of these cuts that are in this, big, beautiful tax bill to Medicaid, making able-bodied people work, for example, are an attempt at that austerity. The second piece is raise taxes. Well, what is Trump doing? They're saying, no, we're actually going to try to cut taxes because we think it's more stimulatory, and then use tariffs to offset some of that income that we're going to cut. And Dalio's worried about that. He thinks it could backfire and it's not enough. And so because what's happening isn't enough, he's thinking DOGE isn't enough, we need more cuts. The tax bill is going to cause more harm than good in his eyes. His only solution is, history says, they're going to print money. They're going to print money. Because what does print money do, other than what I've already said? It makes the value of the debt today less in the future, because money becomes has less purchasing power. So they just keep printing more money, hoping it's going to stimulate the economy without going into major hyperinflation. And that's what he thinks the government's only choice is going to be, given where we are today, our debt levels, our growth levels, et cetera. So it's a dire warning, but I think it's a warning that we should listen to.
Yeah, I think there's a lot there. I think it even goes one step further when we look at what's happening kind of on the field. Obviously, we have this big, beautiful bill that left the House going to the Senate. You know, the calculations are that it's going to add somewhere between $3 and $7 trillion to the national debt. That's what freaked Moody's out. That's what freaks Ray Dalio out.
Yeah.
So, you know, not good. We'll see what happens in the Senate. But I think there's another wrinkle in here that actually makes it, I don't know, more dire, worse, whatever your adjective is. And that is just the fact that foreign countries are increasingly investing away from the U.S. assets,
Yes.
right? And again, it's not entirely. They're not going from, 100 miles an hour to 0, but they're going from 100 to 75 or 60.
Mm-hmm.
And those incremental less investments, they have to be made up somewhere, especially in an environment of rising debt. So
Yes.
really where this goes, and really where this goes off the rails in my eye for Ray Dalio, is at some point the Fed is going to become a buyer, because if the Fed does not step in, Anna, rates are going to go meaningfully higher. Meaningfully higher. I'm talking the 10-year at 6 and the 30-year at 6.5.
Yes.
That will bust the economy.
Yes. And that's exactly what Ray's argument was several years ago, is if you get to the point of almost no return, it's the big money, the smart money. And you and I have talked about this on this show, why I think stagflationary type of risk is worse than just a recession, is because when you get to the point where there isn't a lot of optimism for growth, and we'll talk about growth here in a second, and how this administration looks at growth as the thing that's going to save us, right? But if there isn't enough growth, then governments, the big smart money knows that what the government eventually will do when they can is they're going to stimulate the economy with lower rates. They're going to try with lower Fed funds rates and with printing money. That's how they get people to get out of the funk of what is a stagnating economy. But when you've already printed so much money leading into that period of slow growth, as we did during the COVID recession, if you will, so much money was printed that it created what the government said would never happen again. Big inflation, right? Modern monetary theory was the call of the day. And global central banks thought we can print as much money as we want. Our debt level doesn't matter, because if we have a reserve currency, we'll just continue to print and it'll never create inflation. Well, they were proven wrong when they created, on a bipartisan basis, if just so that we're clear, during COVID, they printed so much money, they gave us all free money, right? Whether you stayed at home or whether you worked, whether you were an individual or corporation, you were given money by the government. That means people went out and spent like crazy, and it created inflation. So now you've got this dual, two-headed monster of low growth and elevated inflation at the same time. And as you and I've talked about on several videos before, it's really difficult for central banks to navigate away from that, because if they cut rates, and they cut them too quickly while there's still inflation, people are going to get excited. All the money on the sidelines is going to rush in and invest, which they want for some stimulation, but it could cause more inflation. But if they keep rates high, it can eventually really be a drag on the economy and put you into a deep recession. And both are hard to get out of. So we're at this place right now where we've got so much debt that the threat of that debt increasing based on the tax bill, based on the tariffs, and that slowing growth has the big money freaking out, which is why you saw 10-year treasuries hit over 5% again last week, right? The bond market is saying, whoa, not enough cuts in your Doge, not enough tax revenue coming in. Now, tariff threat is going to slow growth. We know the only option is to print money, and that means that our money and our investment value on that money is going to be less. So we're demanding a higher rate. So to your point, there was basically a failed treasury auction, which is what everybody's afraid of. When the government puts out, okay, we're going to issue 2-year, 5-year, 10-year treasury bonds, and not enough people buy them at that rate. Basically, the Fed doesn't control the treasury rate. It's the buyers that say, we're not buying until that rate that you're paying us goes up, to give us a little bit more safety and a higher interest rate to hold that money long term. They have to have enough faith in the ability of the U.S. to service that debt, to pay them that interest rate. And they have to trust that we're not going to have so much inflation, that the government's not going to have to print so much money that even that 5.5% isn't good enough. And so what happens is either the Treasury has to allow, that rate to rise to the point that the bondholders and the hedge funds are willing to buy at that rate and say that's enough for us to compensate for the risk of hyperinflation, for example. And if they can't, they do something called yield curve control, like you were just talking about. The Fed steps in and they buy the treasuries themselves. They still have to pay interest on that, which still makes the debt go up. But they basically have to try to manipulate where treasuries are going to be by how much they buy and sell of those treasuries. And it's very difficult to do in and of itself. But if you don't know where fiscal policy is going to be, where governments are going to take fiscal policy, what they're going to do with austerity, what they're going to do with tax cuts or increases, and how much money they're going to spend, it's very difficult, especially in a politically polarized, charged world, for the Fed and the government to work together, Congress, to create what Ray Dalio calls a beautiful deleveraging. Everyone's got to be on the same page. Everyone's got to say the future of our economy is at risk. So we're going to accept less government programs. We're going to accept higher taxes. And the one thing that I'll just say, and I'm sorry, this is kind of a long-winded answer because it's so complicated, right? Is Trump isn't really afraid of this. At least he's not showing it. What they're saying, what Scott Bessent is saying as well, is, well, the thing that Ray Dalio didn't really take into account was a lot of productivity growth. So they're hoping for this productivity miracle that we're going to have so much growth. They're trying to slow the deficit spending to no more than 3% deficit spending per year. So they're not trying to stop the growth. They're trying to bend the curve to where it kind of flattens and then get productivity high enough that they have more tax base, more people to tax, so that even with lower tax rates, they can bring more tax revenue. And it remains to be seen whether or not they will be successful to get that growth, get that productivity miracle enough that when they combine less expenses, some austerity, and then hopefully growth with more tax revenue and more tariffs, that they can stabilize things and prevent us from going into hyperinflation. Government printing money is the only option left.
Yeah, I mean, all of this is exactly where I wanted this conversation to go, with one little wrinkle. Again, I think Scott Bessent is out there trying to save the big, beautiful bill. He said, I think it was yesterday, that he expects the U.S. economy to be growing at above 3% this time next year, which is, part of the 3-3-3 plan, right? Get GDP growing. Yeah. The wrinkle in all of that, just like these tariffs, just like bringing manufacturing home, all of these complicated things we're trying to do, is I see a lot of pain now.
Yes.
But the goodness doesn't come for 12, 18, 24 months.
Or longer.
Exactly. And this just seems like a timing mishmash to me.
Yeah, it definitely. And I think it's what's creating so much more volatility and so much more fear in Main Street and Wall Street, the bond market, the stock market, real estate investors. It's like, what's the next shoe to drop? And there's so many conflicting views from well-meaning economists, that some who are more, Keynesian, some who are more, old school versus modern monetary theory. Their theories about how all this plays out are very, very different. And so you have to basically be malleable enough to say, you can't have certainty that just because it worked out in the past this way, it's going to again, because there's so many differences. There's truly a shifting of supply chains and of global cooperation and of alliances. And because it's so different, and that's part of why everybody's so afraid, it's because nobody really knows, who do we believe and how will it play out? And a lot of it, to be honest, my concern is it's outside of our control to some extent. How do our allies and non-allies and competitors try to take advantage of the changes? How much do they try to control? How much do they try to punish America for the tariffs? How much do they say we're out, to your earlier point, that we're not buying treasuries?
Yeah.
How much does it accelerate the BRICS nations saying, hey, we're not trading in US dollars anymore? And if they're net sellers of bonds while the US is trying to get buyers, that can force rates up higher, and that could harm us. And so, there's a lot of good and a lot of bad that I see could come out of this. My hope in all of this, Michael, is to say, number one, we've got to be really defensive and very cautious in what we invest in. We can't assume that locking in a 10-year treasury at 5% is amazing. It is historically, but what if inflation goes to 7 or 8 and stays there for years? Not going to be too good, right? And so you want to be defensive, but you want to have enough risk tolerance that you're willing to play and grow, your wealth. You want to make sure you're focusing on income, but we really don't know where things are going. And so, one of my concerns really is that the next couple of years, there's going to be so much pushback politically within the United States, within the two parties. There's barely, an advantage in both the House and the Senate for the Republicans to push through their agenda. And so if you have polarization and a refusal to work together to at least move things forward, you're going to have a government that's unable to respond to whatever comes and what other nations do to try to kick us when we're down, for example. And so, historically, if you read Dalio's book about the changing world orders, is when countries start to really be in pain economically, it creates more internal conflict, higher risk of civil war type of things. And it makes the other countries that are trying to, surpass us go, now's the time to get them, because they can't respond. And so we're starting to see a lot of that talk. If you listen to not just mainstream news, but you go listen to meetings of the IMF and meetings of the BRICS countries and the World Economic Forum, like, they're going, we're tired of being beholden to the US. They're struggling. They're making us struggle. We don't want it. And there's a heightened risk of external war. So I expect a lot more volatility than what Bessent, as much as I like him, is they're painting a pretty rosy picture of no problem, don't worry, all of this is going to be worked out in 12 to 18 months, all the trade agreements and all this stuff, and we're going to have so much growth in the next 12 to 18 months that you just need to be patient about how bumpy it's going to be. Call it pessimistic. I'm really an eternal optimist. I really am. But most changes takes 16, 18 months to go through anyway, including an interest rate cut, including tax changes. So, I just think there's so many more factors that are outside our control and the control of our government, that the likelihood is, Michael, I'm bracing myself for a decade of volatility, slow growth. And if these things aren't done by the midterms, you may have another administration that tries to reverse course again in a couple of years. And then that's more years of volatility. So I think we are kind of in a great fourth turning. If you follow, Neil Howe's studies and research on fourth turnings, and just like we had an industrial revolution, we have a tech revolution, like what's next? We're in an unfolding. It's going to be really uncomfortable for a while, and time will tell when something great changes things and puts us on a really great path again, which I do have hope for. But this is not going to be, if I were a betting person, I'd say this is like 3, 4, 10 years before we start seeing the real good or bad that comes from the policies today, and the amount of debt that we have in our system, making the options fewer and fewer to bring us out to a really great place where the economy is growing and benefiting all.
Yeah. So the last thing I want to play with again, if Ray Dalio is right, I see the dominoes like this. We're going to see in the short order, let's call it the next 90 days, the 10-year and the 30-year note spike. Let's say the 10-year goes from 4.5 to 5.5, and the 30-year goes from 5.1 to 6.5, whatever it is. Then at some point, because of lack of demand, the Fed or the Treasury is going to have to come in and be a buyer. They're going to slash rates. They're going to grow their balance sheet again, forcing rates lower if they can. So if that's going to happen over the next 6 to 9 months, what's an investor to do? Because again, in the short order, mortgage rates, right, we're real estate, go up.
Yeah.
But longer term, they're probably going to go down, right? If the system continues to work as is. So, what are we supposed to do today? Are we supposed to just sit on cash and keep stacking? Are we supposed to write disrespectful offers and find deals that cash flow today, and then if rates go lower in a year, you refi? What are investors supposed to be doing?
Yeah, it's a really good question, Michael. And I think, the number one thing for me is in times of true uncertainty and a lot more chances for more volatility than less. I think regardless of where you are in life, asset preservation and income preservation has to be your first and foremost investment criteria. Okay. So when I was in financial, in banking and financial advisory, basically we always told clients this: depending on where you are, you have only one of three investment goals. It's either more growth and appreciation for the future, it's more income for today, or it's preserving what you've worked so hard for, which usually comes later in life. And we all want all three of it, right? We want to make as much money as we can for the future. We want as much income today, and we don't want to lose anything. So all of them are important. But in times of this kind of volatility where there's so many options, you've got to make preservation number one. So I'm going to say something that's not really investing related, but you better make sure your job is secure. And you need to make work on your skills and make your skills marketable. Layoffs are probably more and more coming, right? More potential bankruptcies, because as inflation goes up, profits come down, companies start to lay off. You have slowing growth and you have more recessionary type conditions, even while you might have inflation. So make yourself valuable. Think about side hustles. One of those side hustles for you and I, it was buying cash flowing real estate that created more income. The reality is that's really hard to do right now because prices are still elevated in most parts of the country. So if you want cash flow, you're going to have to go to areas where taxes and insurance are not crazy, where price to income levels in that area are still fairly low, kind of more like mid-America, right? Like the Ohios of the world, where the prices didn't go crazy as much as in the South, but where jobs are still pretty stable. So you want to look for income in whatever way you can do it. Then you want to invest for growth, but it's very hard to invest for future appreciation if you don't know that that's an area of the country that's going to appreciate no matter what happens in the world. So if you're looking for investments that do well, real estate related, you want to be in areas of the country, back to the fundamentals, that have lots of job diversity, lots of different companies in lots of different industries, so that any one thing like tariffs on steel all of a sudden don't put all of the automakers out of business, right? So you want to be in areas that have a lot of people moving there for jobs, that are fairly conservative and pro-growth, low taxes, because it's going to make companies and people continue to go there. And there's going to be more demand for the housing that you want to provide, for example. So invest in really strong areas of the country, not just saying I'm only a multifamily investor or a single family investor or a vacation rental investor. Look for strong income, and that those areas will give you some natural appreciation, even if the rest of the country may not be appreciating. Even if we have what I argue is a flat decade over the next 10 years, find the pockets of the country that are going to be the most strong and resilient. And that's going to give you your best outcome as a real estate investor for both appreciation, for income growth that allows you then to raise your rents commensurate with the incomes that are going to continue to grow. And it's going to give you some preservation and protection from downturns, housing crashes, an area going bankrupt that makes everything less valuable. So I still love real estate. And one of the things that I've done in some speeches that I've done over the last couple of years is warn about this. Like, what if we have stagflation? What if we have deep recession? What if we have mass inflation? What does well? And I can tell you that historically, real estate in strong areas, rental housing in strong areas, does well in all of them compared to many other investments. So I'm excited and thankful that I'm a real estate investor. I'm still looking for really great deals. For me, I'm in preservation mode. So I'm not going to take a lot of risk, especially with higher interest rates, unless I'm in an area that has a lot of growth, undersupplied housing, strong incomes, and then I'm going to make disrespectful offers. Like you said, I'm going to try to steal it on the basis without harming anyone. Win-wins, right? But you got to get an amazing deal if you want appreciation, because you can't bank on that appreciation. You have to make that appreciation on the buy by buying it below replacement cost or close, buying it at a low basis, so that even when the economy, has its ups and downs, it's going to be worth more in the future. And you got to make sure you cash flow, Michael, whether you want income or not. If you're not cash flowing on the asset today and prices go up, labor goes up because of tariffs, for example, taxes and insurance go up, you could be upside down and have alligator properties really, really quickly. So we have to be patient. We have to not do deals just to do deals, but we got to look at deals every day. Like you say, do the work, like your hat says. You got to do the work. You got to find the opportunity. It's going to be harder to do, but if you're doing the work every day, you just get really good at saying no, 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 until you find like a heck yes, it's got cash flow. I'm buying it below value. It's in a strong area that's going to keep growing. And then you just stay disciplined and you wait for time to, make those properties valuable.
Yeah, the last thing I want to ask on this, again, I'll ask it for the average person, and then I'll ask it for us because the answers might be different. One thing I'm looking at when I look at the dominoes, because I talk about it being the next 90 days, 6 months, 9 months, but it really could be much longer than that. Timing is a wild card.
Yes.
One of the things that I'm looking at today is I am not taking on any new short-term debt, and I'll define short-term debt as 5 years or less. Yes. I don't care what the deal is. If I had to do a 3-year debt on it, I wouldn't do the deal today. I don't want that interest rate risk. So when I talk about the average person watching this, they probably should focus on residential, where 30-year fixed is easier to get. And commercial today is probably a spot where the average, somebody starting, they probably shouldn't be looking there given interest rate risk. What do you think?
Yeah, I would say I generally agree. I'm going to give a nuanced answer, though, in terms of what we mean by commercial, right? So generally speaking, I can get a DSCR loan on anything up to 4 units. Some lenders will go 5 or whatever.
Yeah.
1 to 4 units is considered residential, and 5 plus is considered commercial. However, if you're working with a local bank, which sometimes you can get the best terms with a local bank versus DSCR lenders, it depends. They're going to consider a commercial loan anything you're not living in. So it could be a single family house. It's still a commercial loan. One of the benefits about commercial loans, now the benefit of residential, you can get that 30-year fixed payment. Do I want a 30-year fixed payment at 7 today or 8? Not unless it's a killer deal. As long as it cash flows and I'm buying it below what it's worth, if the rate's 8 and it still works, fine. You've got some prepayment penalties that come along. So the question is, you got to kind of balance the risk of rates will be much higher, or it's going to push us into such a deep recession that rates will be cut temporarily, and the global recession will make buyers of treasuries want them at lower rates and treasuries will fall. But the thing I like about commercial loans, again, whether it's a 1 family or a 100-unit property, is if I go to a bank, most of the bank's interest rates are based on the short-term rate, like the Fed funds rate, not on the 10-year treasury in which the residential loans are based. So there are situations where if I go to a local bank today, if we have the recession part that comes before the mass inflation potential, and I believe that we're there or close to there, and that these tariffs may push down growth to the point that we're in a recession, the Fed will drastically cut rates at that time. When they do, your commercial loans with a local bank are going to be much lower, because even if the bond market's rejecting treasuries and treasuries go up when the Fed cuts rates because of that future debt risk, is if I'm going commercial, I can get those short-term rates really, really low and much better than that 30-year fix. So I'd rather go to the local bank. Let's say the difference is 5% versus 7%. I will go to the local bank at 5. But instead of locking it for 5 years, usually you pay an extra 1/4 point and they'll lock it for 7. You pay an extra 1/2 point, they'll lock it for 10. For me, if I can lock in for 10 years, I think most of the volatility shakes out. I'm hopeful enough that in a decade it's there, that I'd be very comfortable going with commercial loans that don't have as long of a prepay, lower rate that boosts my cash flow than I am going a DSCR, locking in a high rate for 30 years. When I'm hopeful that eventually the interest rates will come back down because with high inflation comes low growth. And so they're always going to be battling each other. And we just don't know where things are going to land.
Yeah, love that. Love that advice. Anna, where can people find you?
You can find me here on your channel, on social media at Anna Kelly REI Mom. And for real estate and wealth coaching and consulting, you can book an appointment with me at AnnaKellyInvesting.com.
Thank you so much.